whole life cases. One is there's a tremendous opportunity. With all the baby boomers reaching age 65, what's happening is that a lot of these baby boomers are having...
it so it would be easier so I didn't have to write.
Yeah, I wish you would.
Kelly? And what's happening is that a lot of these baby boomers are having grandchildren. And what I've learned is that a lot of these grandparents love their grandkids. I don't want to say they love them more than their own children, but I will say that the grandparents are spoiling these grandkids a lot more than their own kids. And I'll share a story with you about my mom and her grandkids. It was exactly a week after Christmas this year, and she had two of her nieces, and they went out, and when they showed back up, they were each of the granddaughters had their own stick horse. And I asked my mom, I said, Mom, why'd you buy them those stick horses? Christmas was only a week ago, and they received all kinds of new toys and such. And my mom's simple response was because they didn't have any stick horses. And so my point is this, is that grandparents love their grandkids. They love spending money on them. They buy a lot of toys and other things for them. Why not incorporate, a life insurance policy into one of the things that they purchase for it? So, one, there's a tremendous opportunity. The second reason why I'm here talking about juvenile policies today is because at Assurity, we sell a lot of juvenile whole life policies. In fact, about a third of the policies we sell are actually on juveniles. So it's one of the markets where our product is designed and is really competitive, and we've just seen an increase in business in this market. And so Kelly and Kathy there at Premier wanted me to jump on today and kind of talk to you about where client or agents are out selling these policies and how they position them to the clients. So really, there's two things that we're going to talk about today. The first is what's in it for the client, and then the second is what's in it for you, the agent. What are the benefits for both of those? And first, let's take a look at what's in it for the client. The greatest advantage of purchasing a life insurance policy on a juvenile is that you're protecting their insurability. We all know that things happen, health changes, whatever the case might be, but purchasing a life insurance policy early before there are any medical conditions is the only way that you can insure and protect insurability. And the great thing with juvenile policies is that you can actually add riders that allow you to purchase additional coverage on down the line without having to prove insurability, and so that's a great feature to add as well. The second advantage of writing a policy on a juvenile is that you're going to take advantage of time. And it's not really time value of money, but it is similar. And so let me give you an example of this. A 5-year-old male, if you bought a $50,000 whole life policy with a $10 value enhancement rider, the total premium would be $514.50 a year. Okay, so over the course of the next 60 years, or up until that client turns 65, they would have paid almost $31,000 in premium. But their cash value in this plan over 60 years would have grown to $117,000 of cash value and $218,000 of death benefit. And so my point is this. First of all, buying it when you're young and a juvenile, the cost is going to be less, right? And then the second, you're going to take advantage of time and the ability to earn dividends with a participating whole life plan, and as a result, that cash value is going to really exceed the total premiums paid, and then also you're going to have a nice death benefit when you start reaching your older ages. So over the course of 60 years, they would have paid $31,000. They have a cash value of $117,000 and a death benefit of $218,000. And so there's a huge advantage about starting early with a participating whole life. Something that we run into all the time here at Assurity is we work with baby boomers who waited to buy life insurance, right? So either they either had term insurance and that term insurance is expiring, maybe they had group coverage through work, but the bottom line is now they're 65, they're thinking about how they're going to cover their final needs, their final expenses, and as a result, simplified whole life is often sold to that older generation. And what's happened is it's really became really expensive, right? Well, by buying a juvenile policy and locking in that insurability, taking advantage of time, you can create a situation by the time that they are 65, if they want to stop paying premiums, they can, or if they want to continue to pay premiums, they can. But you're giving them the option, and you're making sure that they're going to be able to qualify for life insurance. So time is the second reason why you should talk about juvenile policies. The third reason you should talk about juvenile policies is really just the fact that you're teaching financial responsibility. If you read any overall financial plan, financial guidance, life insurance is going to be a solid foundation of any financial plan. And by starting a policy early, you can teach that child really the financial responsibility and the advantages of having a life insurance policy in their portfolio. Obviously when they're 5 years old, they're not going to appreciate it, but I guarantee you, when they're 40, 50, and all of a sudden the dividends are going to be exceeding the premiums that they're paying on their policy, they're going to really thank you or thank their mom or their grandma or grandpa or father for purchasing this plan. So teaching financial responsibility is the third thing, advantage for the client. So you, the agent, you might be saying, okay, but what's the advantage to me? One, obviously, is additional revenue. Now, juvenile policies aren't going to be huge premiums. They are going to be relatively smaller premiums, but they add up. They're an easy sale, and it is a way that you can create additional revenue over the course of time. But really, the main advantage is adding additional value to your existing clients. Think of your A clients, the ones that you always are looking for additional ways to provide value. Here's an easy way to reach out to them. You probably know when they have kids or grandchildren. Here's an easy way to call out to them and talk to them about the 3 advantages for their grandchildren. Remember, the protecting insurability, value of time, and teaching financial responsibility. And you're just providing additional value to these top clients. And like I said, they're not huge premiums, so they're not, price isn't going to be an issue. It's just going to be a matter of whether or not they want to move through with it. But then the second thing that I like about working with juveniles, and this all kind of depends on where you are at in your career. If you're, on the way out, if you're about ready to retire, this one won't apply to you. But if you are building an agency and you're going to be in this business for a while, or if you're bringing maybe somebody else that's younger into the business that's going to take over for a while, one of the huge advantages of a juvenile policy is that you're creating a pipeline for prospects in the future. Now, you got to have a little bit of forward thinking, a little bit forward sight, because they're probably not going to be transition to a full-blown client for maybe 20 or 30 years down the road. But you're going to be the first person that has contact with them regarding insurance because you already have a policy on it. So 20, 30 years down the road, when these children grow up, get married, start families of their own, they're going to be a prospect for you to go back and provide other financial services. Or if you're, passing your agency on maybe to a child or somebody else, another family member, it might be a prospect for them. But basically what you're doing is you're laying the foundation for a pipeline of clients by writing these juvenile policies. So really the advantages to you, remember it's a way to add value to your A clients. It's going to create additional revenue, and then it's also going to create a pipeline of prospects. So really those are the 3 advantages for the agent. We talked about the 3 advantages for the actual client. So Kelly, are there any questions regarding what the juvenile policies that I'm talking about?
I don't see any questions here, Seth, but what would you say would be the best way for an agent to approach a client, be it a grandparent or a parent, about doing a juvenile policy?
Yeah, that's a good question. And I like to, when talking about juvenile policies, I like keeping it positive and looking at the benefits, like the cash value instead of the death benefit. No one wants to talk about their 5-year-old grandbaby dying, and so talking about the life insurance isn't necessarily the best way to go. I like pointing out the cash value and how much it can grow over the course of that child's life. So I like to keep that positive. I like talking about teaching the financial responsibility. I think that's important, and they like that aspect of it. So I try to keep it more positive. I do talk about protecting insurability. But I don't put too much emphasis on the health aspect of it or the death benefit aspect of it, just because it's no one wants to talk about their 5 or 6-year-old child dying prematurely, although that is a risk. So I put more of an emphasis on the cash value and also the teaching their financial responsibility, and just try to throw that additional death benefit in there as a value added.
Well, Seth, so that's great, and one of the things that, my parents did for me as a young child was they did exactly this. They took out a cash value whole life policy on me when I was very young, and so that was instilled in me from a very early age. And so when I had my children, that was one of the first things that I did after they were born. And it wasn't so much to think about them dying, but to protect their insurability and to have something that would be cash value for them later in life. So what does the underwriting process look like for a juvenile policy?
Yeah, so at a surety on the juvenile policies, you know, it's a pretty straightforward, streamlined process. You know, the juveniles won't have to go through any medical exams, parameds, blood or urine. So you do fill out the full life application that you would for any other life products at a surety, but you basically submit it. We're going to order an MIB script check. The parent may have to do a phone interview if, you know, something comes up, but other than that, they are streamlined and they get turned out fast. I wrote a couple of these juvenile policies on my nieces and nephews, and you know, they were issued in about 4 days. Now, of course, you know, that I filled out the application correctly. They had a clean bill of health, but you know, they're not going to have to do any of the exams or anything like that. So it's pretty much you fill out the application, submit it, and they're going to get issued. You know, do make the parent aware that that if there is a phone interview, that they would be the one that would be conducting it regarding their child's health.
Excellent, Seth. So are there any financial guidelines that an agent needs to be aware of for a juvenile policy?
Yeah, so right now the maximum that we'll issue on a juvenile regarding the financial guidelines is up to $300,000 of face amount. Okay, so that's kind of where we're at a maximum standpoint, is $300,000 of face amount. Now, in some situations, if it makes sense, if you have a real high net worth family and you can prove financials, we will go above that. But a general rule of thumb is $300,000 is the maximum. The other thing that you need to make sure that you're aware of is that the parent needs to have 2 times the amount of death benefit. Now, they don't have to have that 2 times the amount of death benefit with a surety. If they have it through work, that's fine. But they do need to have 2 times the death benefit on the parents. It can be term insurance. It doesn't matter. They just need to have that 2 times. The other thing that I'll kind of mention regarding financial underwriting is that if a grandparent is buying it or even a parent's buying it, they want to see an equal amount purchased on all children. So meaning that if right now they have 10 grandkids and they want to buy it, you know, a surety is going to require them to buy the same amount on all 10 grandchildren. So what I tell people is the best thing to do is, you know, talk to your clients as they have the children. That way they get these policies in place and enforced, and it's not as big of an ordeal, you know, as they go on and have a lot of grandchildren. So those are really the 3 financial guidelines that you need to be aware of. Is that, remember, up to $300,000 of face amount. Parents should have 2 times the amount of death benefit, and you know, we do need an equal amount on all the children from a financial underwriting standpoint.
Got a couple questions here, Seth.
Okay.
I have. Why should an agent pick a surety for a juvenile policy?
Yeah, there's a couple of reasons. One is that the easy process to get it in to get the policy in force with the you know, the non-medical underwriting, basically fill out the app and submit it. So convenience is going to be the first reason. The second reason is because of the cash accumulation aspect of it. You know, a surety, we are a mutual company, and so that means that the whole life plan that we're talking about is a participating whole life plan. And so what that means is that your client's going to be able to earn dividends, and those dividends are going to go back into the policy and enhance the cash value and enhance the death benefit. So when you look at some of the other juvenile policies out there that, you know, a lot of them only have a level death benefit. So you look at, you know, in that example that I gave you, we started off with a $50,000 death benefit, right? But over the course of 60 years, our death benefit grew to $218,000. That's because of the dividends that the policy earned. So if they're in this for the long run, a surety is a great policy. You know, a lot of juvenile policies out there, they focus, you know, solely on the first 20 years. or until the child reaches age maturity. Our product is designed for the long term, and so if you want to take the advantage of time, you should look at a surety. So the convenience factor, one, and then also the fact that it's participating and that the cash value and dividends are really going to make this policy look good, especially in later years.
That's great, Seth. And I can personally attest to the dividend paying at a surety. And I'm not going to tell you how old I am nor how old my policy is, but I've been paying on it as an adult myself for many years, and there's never not been a year that's gone by that I've not received dividends on my policy, and I think that definitely speaks a lot to how solid your company is.
Yep, absolutely. We take pride being here located in Nebraska, and the stability that we've had and the ability to pay the dividends over 125 years. We look forward to doing it another 125 years.
That is great. You talked about that $50,000 death benefit. So if a policy was taken out on a child as a newborn, and you did a $50,000 death benefit, how much cash do you think could be accumulated for that newborn over a 20-year period to use for college?
Yeah, it's not going to. The thing that you have to realize is that a $50,000 premium on a newborn is going to be less than $50 a month into that policy. So I mean, you're going to have more cash in it than you would have. You're going to have more cash than premiums you paid over a 20-year period. But it's not going to be any if you're only putting $30 a month into a policy, you can do the math, and it's just not going to add up to that much just because of the lower premiums. When you talk about college funding, and that's kind of a whole different product. You can use these juvenile policies for college funding, and they'll work for that. But what I've seen, or my experience has been, if you want to do college funding, I typically look at putting the life insurance on the parent, and then for a couple reasons. One is if the parent dies prematurely, the death benefit's there, and so the plan self-completes. But then also you get, if you're doing college funding, you'll need to add what's called a value enhancement rider, and that value enhancement rider again is going to enhance the cash value and enhance the death benefit. But if you write it on the parent instead of the juvenile, you can get a little bit better of a ratio, and so you can actually build up more cash over a 20-year period if you put it on the parent instead of the child. And the reason for that, because you probably are saying, well, but the juvenile, the cost of insurance is going to be lower, and that is true. But when you start doing max-funded policies on juveniles, you start running into MEC issues, and so you just can't get as much cash into the policies as on the parent, and that is because of the lower cost of insurance. So you can use a juvenile policy as college funding, and it's a general rule of thumb is whatever you pay into the premiums, and 20 years, it's probably going to have a 1 to 2% growth of however much you put in over that first 20 years. Now, the longer you get out, the better your internal rate of return is, but from a general rule of thumb, that's how much cash you could expect on it.
One other question that we have out here is, say the grandparents take out this policy, how is that premium payment transferred to another payer when the grandparents pass away?
Yeah, I mean, you wouldn't need to transfer ownership, or you'd list who the contingent owner is on the policy. So, I mean, it's a matter of filling out a form and transferring that on. Depending on how old the child is when the grandparent feels like it's time to transfer it, whether or not it'd go to the parent or to the grandchild. But from a technical aspect, it's just a matter of filling out a form to transfer the ownership.
Pretty simple process, definitely.
Yep, definitely.
Well, yeah, I don't see any other questions out here, Seth. So just thank you so much for your time this morning.
Yeah, I want to add one. I want to add
sure, go ahead.
that I almost forgot to talk about. At a surety, we have right now where agents can qualify for our leaders conference based on 2015 production next year, which is going to be in Hawaii. And right now we have a contest going on where you can get up to $25,000 of credit towards that trip based on policy count. And so what I've been telling people, one of the easiest ways to take advantage of this contest, because it's on policy count, not premium, is to actually go out and write juvenile policies. So if you can write between now and the end of May, 12 juvenile policies, will actually give you 25,000 credit towards that trip. So that lowers the qualification all the way down to 50,000 to get an all expense paid trip to Hawaii. So just want to throw that out there, that if you do have some juvenile cases, you should try submitting them before May 31st to take advantage of that contest.
That sounds great. And Seth, while you were talking, one more question popped up here is, if they transfer that policy, would it be subject to gift tax?
Yes, it could potentially be subject to gift tax. But the thing that you got to keep in mind, well, you're just going to kind of want to look at what the total cash value is, and there's a whole calculation regarding gift tax, because they're going to take into consideration premiums that are going to be paid and what the actual cash value is. So that is something that you do need to be aware of. But remember that your annual gift tax exclusion is $14,000 a year. So with these smaller policies, it does take a while to get up to that point. Obviously, if you're, wait 34 years out, it's going to play more of a role. But typically, within the first, 20 policy years, that's not going to be as big as a factor, because it is going to fall under that gift tax exclusion. But there's actually an actuarial calculation that relates the cash value to the premium as far as what the gift tax or what the actual amount of the gift is going to be. But it is something that you do need to be aware of.
Okay, Seth, one other thing here. You mentioned paying this over a period of time. Is it better to have this be a continuous pay type policy, or is it look better for clients, or do anything better for the policy if they do it just as a short pay, maybe have it paid up in 10 years or 15 years?
Yeah, that's one of the advantages of our policy in this market, is that you do have that flexibility. So we can design this product to be a 10-pay. We can design this product to be a 20-pay. We can design this product to be a paid up at 65. Is there any advantage of one way over the other? It's all going to be relative. Obviously, if you're paying it for a shorter amount of time, your premium is going to be higher. So what we do is we add the value enhancement rider to get the cash value high enough that we can do what's called a reduced paid up in any given year. So, that's one thing to keep in mind. But it really depends on what the client wants to accomplish and what they're trying to accomplish, as far as one way is better than the other. Over the course of time, the continuous pay obviously is going to build up more cash value and have a higher death benefit. But the good thing is that it's up to the client. They can decide, and then we'll customize the plan to meet what they're trying to accomplish.
Great. We talked about grandparents purchasing these policies for their grandkids. What kind of communication has to take place between the grandparents and the parents when a policy is bought for a juvenile?
Yeah, the parents will, both the parent and the grandparent will need to sign the application. So because the parent needs to sign as the legal guardian, assuming that the parent is the legal guardian. So both the parent needs to be aware that these policies are being purchased on the grandchildren. Unless it was a situation where the grandparent was the legal guardian, but the parent is the one that has to sign for the juvenile. So the parent needs to be aware that the policy is being taken out.
Great.
Hey, Seth, this is Kathy. I have a question for you, too. So on your participating whole life plans, a lot of agents will call us and ask us the difference between a non-par and a par. Can you explain that real quick?
Yeah, the difference between a participating or a non-participating plan is basically a participating plan has the ability to earn dividends. Remember that when insurance companies, mutual life insurance companies, have favorable investing experience and they have favorable mortality costs and favorable operating costs, we return a portion of the premium that we took in at the form of dividends. And so a participating plan is just one that receives dividends. And so remember that you have several options on how you take your dividends. Probably the most popular way that people take their dividends is in what's called paid-up additions. So they basically go back into the policy and enhance the cash value, enhance the death benefit. But if your client wanted to take the dividends as cash, they could do that. If they wanted the dividends to go to the premium and reduce the premium, they could do that as well. So really the difference between a participating and a non-participating is just that the participating has the ability to earn dividends.
Great, thanks for that explanation. One more thing here is if you do have any cases that you are thinking of, I know many of you probably work in the senior market, perfect place for you to be talking to the grandparents of, to those clients because they may have grandchildren that they'd like to do this on. So if there's anything that you do need, you can reach out to us here at Premier. We are more than happy to help you with those illustrations and such. And just give us a call at 800-365-8208 and ask for a life marketer. And then also, Seth brought up the Assurity trip. When you write these juvenile policies and policies through Assurity, those policies also count towards the trip for Premier that will be in Mexico next year. So you can double dip and possibly get 2 trips with your business.
Yep, absolutely.
Yeah. Well, thank you very much, everybody, for taking time out with us this morning. And we will see you all next week.
All right. Thanks, guys.
Thanks.